Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are trying to tell us, and this quarter DarioHealth Corp has a story to tell us with their latest 10Q filing, and let me tell you, it has got some twists and turns. Before we dive in, if you love getting straight talk and clear breakdowns of these dense corporate documents, make sure you hit that subscribe button, and hey, we have a growing community over on Discord, so come join the conversation linked in the description below. Alright, so this is DarioHealth's quarterly report covering the period ending the 30th of September 2025. Think of it as a mid-year check, up for the company's finances and operations. Now, DarioHealth is a digital therapeutics company, meaning they use technology to help people manage their health, focusing on things like diabetes, heart health, weight management, and even mental well-being. They aim to get people engaged with their health in a way that actually leads to lasting change. Let's jump straight into the numbers because that is where the real story often lies. Looking at their balance sheet, it is a snapshot of what they own and what they owe on the 30th of September 2025. On the asset side, they had about $42 million in current assets, which are things they can easily turn into cash within a year. That includes over $31 million in cash and cash equivalents. That is a good chunk of change to keep the lights on. They also had almost $5 million in inventory, which for a healthcare tech company probably means devices or components for their digital therapeutics. Now, for the liabilities and stockholders' equity, that is what they owe and what the owners have invested. They owe about $9.2 million in current liabilities, things like trade payables and accrued expenses. That is pretty manageable. But then there is their long-term loan, which stands at over $30 million. That is a significant chunk of debt they need to manage. Overall, their total assets were just under $118 million, while their total liabilities and equity were also just under $119 million. It is a tight balance, and that loan is definitely a major commitment. Now let's look at how they've been performing. This statement shows their revenues and expenses over a period of time. For the 3 months ending the 30th of September 2025, their total revenues were about $5 million. That is a drop from about $7.4 million in the same period last year. And for the 9 months, revenues were $17.1 million compared to $19.4 million. So revenues are down. Where did this drop come from? Well, it looks like their services revenue, which is a big part of their business, took a hit. It fell from over $5.6 million down to $3.2 million in the third quarter. This is mainly because of a customer they acquired through the Twill acquisition not renewing their contract. Losing a big customer is never good news, and it clearly shows in the numbers. Despite the revenue drop, their gross profit, that is revenue minus the direct costs of making their products or services, actually went up as a percentage of revenue. For the third quarter, it was 60.2%, up from 52.2% last year. For the 9 months, it is 57.6%, up from 46.6%. This is good because it suggests they're becoming more efficient at making their money. They're spending less on the direct costs of revenue relative to what they bring in. But then you look at their operating expenses and things get interesting. Their research and development costs went down significantly, by almost 39% for the quarter and 41% for the 9 months. They say this is due to efficiency and integration efforts after acquiring Twill. While cost cutting can be good, dramatically cutting R&D can be a red flag for a company in a fast-moving tech sector. Are they slowing down innovation to save money? Sales and marketing expenses also decreased by about 31% for the quarter and 24% for the 9 months. Again, they point to payroll and post-merger integration. Lower marketing spend might mean they're not reaching as many new customers, which could explain the revenue decline. General and administrative expenses, which are things like executive salaries and legal fees, increased for the quarter, but decreased for the 9 months. They mention that the 9-month decrease is due to lower expenses related to the Twill acquisition that happened earlier in 2024. All of this leads to their net loss. For the third quarter, their net loss was about $10.5 million, which is actually an improvement from almost $12.3 million in the same quarter last year. For the 9 months, their net loss was about $32.7 million, a slight improvement from $33.1 million. So they are losing less money, which is a positive step. They also provide a non-GAAP adjusted loss, which they use to exclude certain items. For the quarter, their adjusted loss was about $6 million compared to $7.1 million last year. For the 9 months, it was about $18.2 million compared to $26.9 million. This adjusted number also shows improvement. But it is important to remember these are ways of looking at the numbers that exclude expenses that are very real, like stock-based compensation. Looking at cash flow, which is super important for any company, especially one losing money, they used about $20 million in operating activities for the 9 months. That is less than the $31.8 million they used last year. This means they are burning through cash more slowly, which is good for their runway. Investing activities show less cash used this year, about $116,000 compared to almost $9 million last year. That big outgoing last year was largely due to acquiring Twill. Financing activities brought in about $24.3 million this year, up from about $20.2 million last year. This comes from issuing more stock. It looks like they're relying on selling more shares to fund their operations. Let's revisit the balance sheet for a moment to see how they're managing their debt. Their long-term loan stands at over $30 million as of September 2025. This is part of a new credit agreement they entered into with Caledine Commercial Finance. This loan has an interest rate of SOFR plus 7.75%, which is quite high. To get this loan, they also had to issue warrants to the lenders, which can dilute existing shareholders. They recently amended this credit agreement in November 2025. This amendment reset financial covenants and waived testing for some quarters following a period where they initially missed a covenant. They also repriced warrants and adjusted conversion prices, which can be a sign of financial strain. But the fact they could get an amendment shows they are actively managing their debt. Now, a quick look at stock-based compensation, which is essentially giving employees stock or options instead of cash. This is a significant expense for DarioHealth, totaling almost $3 million for the quarter and over $7.3 million for the 9 months. While it is a way to attract talent, it also dilutes existing shareholders. Digging into the net loss attributable to common stockholders, we see it as around $9.3 million for the quarter and over $51 million for the 9 months. The basic net loss per S-Hair is showing a loss of $2.96 for the quarter and $9.05 for the 9 months. This shows the ongoing challenge of turning a profit. Now, let's talk about what could go wrong, and DarioHealth details quite a few of these in their risk factors. A major concern is their operations in Israel. With the ongoing geopolitical instability in the region, including recent conflicts, there is always a risk of disruptions to their business. They mention that their insurance doesn't cover war and terrorism, and while the Israeli government offers some coverage, it is not guaranteed. They also highlight the significant impact that changes in US laws and policies, especially around international trade and tariffs, could have on their business. This can increase manufacturing costs and cause delays, which they've already experienced. And then there is the stock price volatility. It has been a wild ride for their stock, with significant swings that seem unrelated to their actual business performance. This kind of volatility can make it hard to predict their financial future and might even lead to impairment charges on their assets. Looking at their sales of equity securities, the company issued 104,000 shares of common stock to service providers as compensation. They are claiming exemption from registration under the Securities Act, which is a common practice for these types of transactions. They also had a private placement in September 2025, selling over 1.1 million shares of common stock and pre-funded warrants for about $17.5 million. This is a significant amount of fundraising, but it also means more dilution for existing shareholders. And here is what might be the most interesting part of the whole report. In September, they announced a strategic review to maximize shareholder value because they've received multiple unsolicited inquiries. This could mean they are exploring options like a sale, merger, or strategic combination. It signals a potential big shift for the company's future. Their disclosure controls and procedures are deemed effective by their management, which is standard for these reports. Let's wrap up by looking at their liquidity. They have about $31.9 million in cash, which they believe is enough to keep them going for at least 12 months. However, they've had cumulative losses since they started and continue to expect future losses. They're dependent on raising more funds, which is typical for companies in their stage. The recent credit agreement and stock sales are ways they are trying to secure that funding. So, what is the big picture here? DarioHealth is in a tough spot. They're losing money. Their revenues are down this quarter compared to last year, mainly due to losing a key customer. But they are getting more efficient with their gross profit. And importantly, they are burning through cash more slowly. The biggest news is the strategic review. This tells us the company might be looking for an exit or a major partnership. The high interest rates on their new loan are a concern, and the geopolitical risks in Israel add another layer of uncertainty. Ultimately, DarioHealth is trying to navigate a challenging market with an innovative product. The question is whether they can accelerate revenue growth, manage their debt effectively, and whether this strategic review will lead to a positive outcome for shareholders. It is a company with potential, but there are significant risks and a clear need for increased revenue and profitability. That is our deep dive into DarioHealth Corp's latest filing. What are your thoughts on their strategy and this potential acquisition news? Let me know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate breakdowns. And again, Join our Discord community. It is linked in the description for even more insights and discussions. Thanks for tuning in, and we'll see you next time on Corporate Decoder.